Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. After a hawkish cut by the Federal Reserve, which caused quite the market reaction, the other monetary policy events, which were the rate decision from Japan and the UK, were rather quieter. Both the central banks decided to keep rates unchanged. Today, on the data front, there's the inflation number from Japan, which is already out, and the PCE from the US. But what's really interesting is the political developments out of the US right ahead of the holiday season. Now, the US government is facing a government shutdown after a Trump backed temporary funding plan is finding troubles getting approved by the House. Good morning, JK. Seems it's going to be a busy season for the US political class. What's your thought on these developments?
Good morning, Swaraj. Yes, politics has been, the limelight for quite some time now. We have seen what has been happening in Europe and, of course, in US also now. The debt ceiling is again coming to haunt the market, although it's not doing anything to derail the dollar's rally. Trump is even suggesting that, we should not have the concept of debt ceiling at all. A very big point, but then it's practically it may not be possible. But so surprisingly there is even no confidence vote that is being taken in Italy just to get the budget passed, because there has been a lot of opposition from the proposals, but then the ruling government does have a majority, so I think they're adopting a safe way to get the budget passed. So politics is not out of the radar at all. Now, geopolitics has taken slightly backseat. Now, coming back to markets, I think dollar is not lacking any of the supporting factors for it. Now, we had Fed rate decision that went in favor of the dollar, in the sense that the projections showed that there will be no more than 0.5% hike next year, no more than 0.5% in the year following. And then there was this inflation forecast that have been put up for 24, 25, and 26, and the target to be met only in 2027. So that was the main trigger for the dollar to rally nearly 1.5% from the low on FOMC day. And Euro and Japanese yen, of course, took the biggest hits. Yield going up above 4.50 has been a big thing. Now it clearly shows that the US dollar is majorly supported due to higher yields, and it will continue to get support due to higher yields. If you look at the data that's come yesterday, it was more supportive. GDP was revised up to 3.1 from 2.8%, which was seen in the second estimate. We had the jobless claims, which dropped by 22,000 week on week, from 2,42,000 to 2,20,000. Estimate was for 2,30,000. Even the continued claims fell yesterday. We had the leading economic indicators that rose 0.3%. It has been going down for the last several months, and it has now shown a positive trend. Existing home sales was highest in the last 6 months, and then the only negative news came from the manufacturing side, and that is been consistently on the negative side. There is been a manufacturing slump in the US, and the Philly Fed manufacturing index was deeply in negative territory, with new orders and employment all taking a hit. But overall sense of the US economy is still strong, because the GDP number was supported by a big rise in the consumption at 3.7% from 3.5%. So at the same time, if you look at the other central bank decision, Bank of Japan did not hike the rate, although it could well have justified by a hike. They quoted, global uncertainties as the reason why they did not hike. Of course, if you look at the inflation number today, which has beaten the estimates on all parameters, I think it would be very difficult to justify not moving on the rate, at least in January. The yen has reacted slightly by recouping some ground from near 158 level to around 157. On the Bank of England, yes, they did hold the rate unchanged at 4.75%, saying that a gradual approach to future interest rate cuts remain right. But then later on, the Bank of England chief, I'm sorry, Bank of England chief actually said that markets expectation of a rate move in February may well be right. So that actually means there will be a rate cut from Bank of England going forward. So all this happening in the face of uh, you know in the face of a hawkish Fed is giving a good support to the dollar. Of course, the other developments in Eurozone also is the current account and the trade account trade balances have been lower for this month, which has been one of the biggest supporting factors for Europe. So all in all, the supportive factors for the dollar are very much there. I don't think this debt ceiling issue, a lot of noise, but eventually we know that historically it always gets settled one way or the other. Or rather, I would say it will be settled to allow the spending by the government and no shutdown should be seen. At least the market reaction does not show that there can be any shutdown as well. Chinese yuan has broken 7.30 mark, which is significant. Even on the onshore, it was about 7.30. Only the Chinese central bank fixing the rate much lower than what should have been as per their own parameters is keeping the yuan from falling further. If at all we get any corrective down move in the dollar, it could be only due to year-end factors. But otherwise, it seems like we will hit new highs in the new year. Same thing goes for USD INR. We hit a new low yesterday at 85.0875, and in fact we have seen some momentum pickup in the dollar rupee after the trade numbers were published. The trade deficit number were published last week. Like in the first 6 months of this financial year, the rupee lost about a little over 1%, and in the last 3 months, less than 3 months, we already lost more than 1.5%. That means the more and more one-sided market is what we are seeing. FI, of course, were the initial big buyers, and now it has also, after 85 breaking, we also see more importers rushing to cover. Not clear about where the rupee will stop, its downward journey, because all the factors are looking very positive for the dollar to continue its rally. So looking for more strength in the dollar, probably short-term corrections or a messy sideways move also cannot be ruled out. Although historically dollar has been a loser in the last month of the year, with 10 days only to go in a volatile market, we cannot rule out some choppy moves as well. Thank you.
Thank you, JK. And it seems a lot of support for the dollar's rally. Hawkish cut by the Fed with projections showing inflation not coming to target till 2027. Yields going higher, giving the dollar the support. The stronger GDP number, which were released yesterday, 3.1% for Q3 versus 2.8% expected. And of course, this number was supported strongly by consumption, which drives the US economy. Even the weekly jobless claims was lower by 22,000. So all these factors very supportive of the dollar's rally, and that's what investors are also currently observing when it comes to other central banks. The BOJ, the global uncertainties actually prevented the BOJ from hiking rates despite today's inflation beating expectations. So that was on the Japanese front. Bank of England held rates unchanged, taking a gradual approach to the rate decision. Chinese yuan has broken the 7.30 mark, which is very significant. And when it comes to rupee hit a new low yesterday, breaking the 85 mark very comfortably. The dollar index strength, and along with the Asian currencies depreciating against the dollar, is keeping the rupee also on the weaker front. That's it from us today. Thanks for listening. Have a very good weekend, and we'll see you all on Monday with a fresh round of updates.